Hey everyone, I'm Ishan, and today I wanted to walk you through a Python-based trading algorithm that I built. So this will be more of a high-level overview, and towards the end of the video, I'll show you guys some backtest results to give you an idea of how it actually performs. So the engine starts off by loading 5 years of historical price data for the S&P 500 using the Alpaca and 12 data APIs. After gathering all of this data, it computes a variety of technical indicators like MACD for trend direction, ATR for volatility, RSI for momentum, and ADX, which gives an idea of the trend strength. So once all these indicators are calculated, the algorithm builds a general trading signal using a moving average crossover. So what's really happening here is we're comparing a short-term and a long-term moving average of the prices. When the short-term average rises above the long-term one, it usually means that momentum is shifting upwards, so it's treated as a buy signal. When the short-term average drops below the long-term one, it signals that prices might be starting to fall, and that's treated as a sell signal. So here you can see those signals being calculated. Now these simple signals are then heavily filtered to improve accuracy. Each potential buy is only accepted if several other additional conditions are met. So for example, we would want the price to be trading above the 200-day exponential moving average, which means that the stock is in a long-term uptrend. We also want the trading volume to be higher than average, and we want the RSI to be below a certain threshold. And these are just a few of the examples of filters that we're using here. So the whole idea behind these filters is we want to ensure that the algorithm only trades in very high probability conditions. So this reduces a lot of noise from the short-term fluctuations. So next, the algorithm adds another layer, which is market regime detection. So the state logic here is pretty much calculating, or it's classifying the overall market into 3 regimes. So there's a normal regime when the markets are stable, a crash regime when the S&P 500 drops sharply and volatility spikes, and then also a rebound regime when the volatility is starting to subside and prices are recovering from that crash. So the regime detection is based both on the percentage drops in the S&P 500 and movements in the volatility index. So by understanding which regime the market's in, the algorithm is able to switch behavior, and it stays cautious during crashes and it's more aggressive during the rebounds. So now that I've explained the basic structure of the algorithm, let's run a full backtest, and I'm going to run this over the last full trading year. So when the backtest runs, the algorithm makes thousands of simulated trades, in this case over 3,000. It records exactly when and at what price each trade is occurring at. So this gives me an idea of the overall performance and also exactly what's happening at every single time step. So I'll split the results into 2 parts, general stats and an algorithm versus S&P 500 comparison. In the general stats section, we can see that this strategy ended up with a total capital of about $123,000, starting from $100,000. This is roughly a 23% gain. It also tracked the largest winning trade, which was Insolits, and the largest loss, which was Mohawk Industries. So the win rate, which means the percentage of trades that closed profitably, came in at 54%, and the profit factor was 1.2, meaning that for every dollar lost, we got $1.20 back. So the second section here compares the algorithm's performance against the S&P 500. So the algorithm achieved a compound annual growth rate of 23.2% compared to the 13.2% of the S&P 500. That means that the strategy grew nearly twice as fast as the market on an annualized basis. The Sharpe ratio, which measures some risk-adjusted return, was 1.29 for the algorithm and 0.51 for the market. That indicates that the strategy generated higher returns with proportionately less volatility. So together, these results show that the trading engine not only outperformed the S&P 500, but also did it with better risk management. The system also generates an equity curve comparison plot, showing the algorithm's portfolio value against the S&P 500 over time. The blue line here represents the algorithm's equity, while the cyan line shows the market. You'll also see these red and green dots. So the red dot marks where the algorithm detected the start of a crash, and the green dot shows where it determined that the crash had ended. So as you can see in this little region between the two dots, the algorithm paused trading. So one limitation of this algorithm is the risk of curve fitting. Since it relies on a lot of indicators and tuned thresholds, it might perform well on past data, but struggle in future markets. As you can see, the market regime logic also boosted performance during the April 2025 crash here, where it detected the sharp drop in the S&P 500 and paused trading. This crash was a very specific case, and there's probably a risk that this detection wouldn't work nearly as well for future crashes. If I revisit this project, I'd move towards an AI-based approach, using machine learning to learn patterns directly from data instead of using these fixed rules. That would make the strategy more adaptive and less dependent on manual tuning. So I hope this gave you guys a clear look into how the algorithm works and the ideas behind it. Thanks for taking the time to watch.